Welcome back to Investment 360. Well, to achieve long-term rates of return, investors have to rely on a total return strategy in which investment returns are achieved both through capital appreciation and current yield. A number of factors have been identified by industry practitioners as to what is considered best practice on how to achieve investment objectives in a challenging economic climate. Mark Thomas, Head of Business Development at Grindrod Asset Management, joins us to talk about this. Well, an interesting introduction. You've just been looking at these issues, a conference that you've been engaging with your stakeholders, investors and so forth. And it really is a difficult climate at the moment.
Yes, hi Alec. Yeah, it's extremely difficult. I mean, no one's ever lived through QE easing before. We're not entirely sure how it's all going to go. We're not entirely sure where interest rates are going to end up. So yes, even though some of us have been in the market nearly 20 years, we've never seen this kind of environment before. Very, very low interest rates, probably set to rise over the next 5 years. And that has really spooked investors, creates a lot of uncertainty in the market. So yes, achieving objectives in this climate going forward is going to be quite a challenge.
Yeah, you mentioned QE, quantitative easing, running the printing presses. The money's been pushed into the system and it has to get taken out at some point in time. And I guess, as you say, the question is when and how is it going to affect interest rates, and what do we do as investors?
Yeah, I think the big question is that when QE does come to an end, because it will at some point, it has to. It's impossible for the printing presses to keep running indefinitely. But when it finally does come to an end, on the one hand, you can say, well, the world is in a situation then where there's a lot of debt that it has to now deleverage and unwind. But on the positive side, we think QE will only come to an end when the global economic growth is self-sustaining. And that would actually be good news for investors because the patient is now off life support and it can sustain itself. So yes, on the one hand it's very challenging, but on the other hand I think that investment objectives can still be achieved focusing on very important fundamentals over the next 5 years.
Yeah, you've got to be smart though. It really puts a premium on your ability to select not just individual stocks but markets.
Yes, well, not just markets, but we also believe strongly in getting the asset allocation right. We know that asset allocation is a big driver of long-term returns, and so you've got to get that right. And I think one of the key challenges, especially South African investors now face, is that in contrast to the last 10 years, where if you sat in cash, you could have achieved above inflation returns. If you sit in cash now, you're going to get returns below inflation. So your real purchasing power is in fact going backwards. So getting your asset allocation right is going to be very important over the next 5 years, and we strongly believe that you need to be in real assets that can grow their profits over time, not sterile assets like gold or like money in the bank or even bonds that can't grow their rates of income. So that's why over time we favor listed equities and listed property, because both of those asset classes have underlying income growth in order to generate capital growth over time.
You've got a great record in property. In fact, if anybody were to consider where to talk to a property expert, they're more than likely to come to Durban and have a chat to the Grindrod guys. But are you not concerned that it's had such a fantastic run that listed property at some point in time is going to underperform?
Yeah, I think lots of people have been saying that for about 5 or 6 years now. And over the last 5 or 6 years, investors that have invested in property have had over 100% in total cumulative return over that time. There will always be periods of underperformance in any asset class in the short term. Even Nick was talking about that earlier from Nedgroup. So we are very comfortable as long as the asset, whether it's property or an equity, and in this case in property, has an income stream that is growing above inflation. We are quite relaxed about the capital values in the short term because we know that in the long term the capital will grow in line with the income stream. We are getting rewarded, though, in the short term with a very high yield, over 8% now in property, which was one of the highest yielding asset classes you can currently get. So we're quite comfortable, even though we do anticipate, as we've seen in the last 2 or 3 months, a period of capital underperformance. But we see it as a very short-term thing, and that over the longer term, investors will be well rewarded with a high income stream and a growing income stream from property.
Mark, Aveng was quite a good stock not long ago. They were paying good dividends, and it was not a cornerstone to most portfolios, but it was included in a number. Yesterday they came out surprisingly and passed their dividend. If you had a stock like that in your portfolios, given the fact that you love to see the dividends growing, would you dump it?
Definitely. We have had that experience with another stock over the last 6 months. And that, hence the need for diversification in your portfolios. We equal weight the assets in our portfolio, so we prevent ourselves from falling in love with the stock, so it builds up to be 10, 15, maybe 20% of a portfolio. So by equal weighting, we manage that risk. So if a stock, and there will always be one in every portfolio at some point, will disappoint you because it's not a perfect world we live in and we can't foresee the future. You've got to make sure that you're well diversified. So if we had an Aveng and it cut its dividend, definitely it would be out the portfolio. But also through the equal weighting process, it would have had a marginal impact on the investors in that portfolio because it wouldn't have been 10, 15 or 20% exposure.
Where does it come from, that idea that companies must pay dividends and preferably rising dividends?
The original quote actually comes from a chap called Benjamin Graham, who was Warren Buffett's mentor. And he actually said in his 1934 security analysis textbook, he actually said that the purpose of a corporation is to pay its shareholders a dividend and increase that dividend over time. And if you even go back in history, you can always see that people invest for future profits. And the best way to gauge those future profits is in the form of a cash dividend. Earnings can be manipulated, as we know, from WorldCom and all those horror stories for investors. But dividends, you cannot fudge them. So we prefer to follow the dividends because that gives us an indication that the company is healthy, it's got a strong balance sheet, and that management is committed to growing that dividend over time. And those are the kind of businesses that we like to have for our investors in the portfolio.
So you wouldn't invest in Berkshire Hathaway, Warren Buffett's own company, although he does say that what he suggests to people is just sell some of the shares every year and it's the same as having a dividend.
Yes, if we were, and we are going to, in the course of next year, managing a global portfolio along these lines, we probably wouldn't invest in Berkshire Hathaway. Having said that, Warren Buffett himself is always very pleased when his underlying investments like Coca-Cola, etc., are paying him a lot of dividends because that's what he then redeploys as new capital into the market. So I think for our type of investor who is dependent on an income stream both now and in the future, Berkshire Hathaway wouldn't be an appropriate security in our global portfolio.
Given, to go back to the overview of this part of the conversation, that we're in a challenging economic climate, is it more difficult for you to find those dividend yielders?
Yes and no. Yes, in the fact that with the challenging economic climate, profits are always under threat. It's not so easy when you've got very low interest rates, you've got good economic growth. If we're going into rising interest rates and challenging economic growth, then it is going to be more difficult for companies to grow their profits. So yes, we have to be very sharp in terms of that. But having said that, especially over the last 3 or 4 months, with markets coming off a little bit, dividend yields have been rising. So for new investors, it's a great time to be investing. When we can construct, for example, an equity portfolio that's got a dividend yield of just under 5%. Whereas if you go back in history, and especially in the last decade, it's consistently been under 4%. So for a new investor coming in now to be getting 5% return just on dividends as a starting point, we think is a good opportunity.
Mark Thomas from Grindrod Asset Management, joining us there and giving us some useful insights into the way that they look at investing.